This isn't just a spike at the pump. It is the definitive end of the middle-class safety net. While the headlines are focused on the ceasefire negotiations in the Middle East, the damage to your net worth has already been hard-coded into the system. As Brent crude touched $130 earlier this quarter, it triggered a mechanism that most analysts are completely ignoring. Here's what you need to understand. The real threat isn't that you can't afford to fill your tank. The threat is that the 25% of American household wealth currently tied to corporate equities is being liquidated to pay for a global energy deficit. We are witnessing the wealth effect in reverse, a calculated destruction of demand that starts in the stock market and ends at your dinner table. For the last 18 months, American households have spent faster than they've earned, buoyed by record-high asset prices. That era just ended. The pattern is clear. When oil sustains these levels, the market doesn't just dip, it breaks the consumer's back. But why did the market react so violently to a conflict that supposedly just hit a pause button? The road to $130 oil didn't start with a single explosion. It started with a failure to recognize a shifting pattern in early March. What began as localized tension in the Persian Gulf escalated within 40 days into a full-scale blockade of the Strait of Hormuz. By April 12th, the situation crossed a critical threshold when the U.S. Navy formalized its own counter-blockade. While the headlines today talk about cooling prices at $95, the damage to the supply chain is already permanent. Historically, we've seen this script before. During the 1990 Gulf War, prices doubled overnight, but markets normalized within 90 days. The difference today is the fragility of the American household. In 1990, your net worth wasn't a hostage to the S&P 500. Today, over a quarter of your wealth is tied directly to equities that are hypersensitive to energy costs. Every $10 jump in oil adds roughly 0.35% to headline inflation. But that is the surface story. The deeper timeline reveals a strategic squeeze by regional actors who know that the ceasefire announced on April 7th was a tactical pause, not a resolution. But this is where the story changes. Most people are looking at the price of gas to gauge their financial health, yet the real threat is hiding in your retirement account. The weekend of April 11th marked the moment the transitory narrative died. In Islamabad, diplomatic efforts led by Vice President J.D. Vance collapsed after Iran refused to abandon its uranium enrichment timeline. By Monday morning, the U.S. Navy responded by initiating a full blockade of Iranian maritime traffic, targeting the very ports that feed the global energy market. What we're seeing is a high-stakes siege. On one side, Washington is attempting to use naval superiority to force a total economic surrender. On the other, Tehran is leveraging its control over the Strait of Hormuz, effectively holding 20% of the world's daily oil supply hostage. The supply shock is real, but the mechanics are shifting from a regional skirmish to a global resource war. But this is where the story changes. While everyone is watching the warships, the real blockade is happening inside the American economy. The sudden price surge to $130 wasn't just a market reaction, it was a trigger for institutional liquidation. This is no longer about the cost of a barrel, it's about the collateral damage to the assets you own. The uncertainty isn't just in the Gulf, it's in whether the Federal Reserve can protect the stock market while the literal fuel of the economy is on fire. This is a fundamental shift in the global economic architecture. The strategic importance of $130 oil goes far beyond the gas pump. It is a direct attack on the American middle-class safety net. What this means for you is that the wealth effect that has fueled our economy for a decade is now working in reverse. When oil sustains these levels, the pattern is predictable. Institutional capital flees the S&P 500 to cover rising fuel and transport margins, dragging down the 25% of household net worth tied to equities. This isn't a theory. It is a structural liquidation of your savings to fund a global energy war. As we navigate these shifts, I want to make sure you're seeing the full picture. If this analysis provides the clarity you need, leave a like so we can reach more people in the same position. The impact is personal. Higher costs for groceries and fuel are the immediate tax, but the long-term damage is the evaporation of your purchasing power. We are entering a phase where the consumer is no longer the engine of growth, but the casualty of strategy. But here's what that number actually means for the Federal Reserve's next move. Inside the Federal Reserve and the major central banks, the conversation has shifted away from the soft landing and toward a managed demand destruction. What this means is that decision makers are now quietly allowing the energy market to do the heavy lifting that interest rate hikes can no longer accomplish. The pattern is clear. Instead of another 25 basis point hike that might break the banking sector, officials are letting $130 oil act as a shadow tax on every single American household. Most people are missing this. The Fed isn't holding rates steady at 3.5% to 3.75% because they think the economy is strong. They are holding because they need the stock market to cool down. When 25% of your net worth is tied to equities, a 10% market correction is a more effective way to stop you from spending than any policy announcement. This is the strategic interpretation. The wealth effect is being weaponized to curb inflation by making you feel poorer on paper. The long-term strategy here is a tactical retreat. By allowing energy prices to stay elevated, institutions are forcing a pivot toward domestic shale and deeper austerity. They are betting that you will stop buying, stop traveling, and stop borrowing before the national debt interest payments become unsustainable. But the other side tells a different story, one that the current market resilience is desperately trying to hide. But the other side tells a different story, and right now, Wall Street is shouting it from the rooftops. If you look at the headlines from this week, April 15 marked a record close for the S&P 500, pushing toward the 7,000-point threshold. The mainstream narrative is one of absolute resilience. Record bank earnings, a cooling fear and greed index that has tipped back into greed, and a belief that the Phase 1 ceasefire in the Middle East has permanently de-risked the energy market. Bullish analysts are pointing to the fact that Brent has calmed to $95 from its $130 peak as proof that the crisis is over. They take this recovery seriously, arguing that American shale and Treasury Secretary Bessent's strategic management will prevent a total collapse. But here's the precise gap in that logic. Market prices are reacting to sentiment, while the real economy is reacting to physics. Even at $95, oil remains 30% higher than the structural average required for stable 2% inflation. The U.S. naval blockade of Iranian ports in the Strait of Hormuz is not a sentiment issue. It is a physical bottleneck that hasn't moved. The flaw is simple. A stock market rally doesn't lower the cost of transporting a gallon of milk. When the S&P 500 hits record highs, while energy prices remain at a destructive floor, it creates a decoupling that historically precedes a massive correction. This gap matters because it is creating a false sense of security in the very middle class that is currently being liquidated. The connection between a naval blockade in the Persian Gulf and your local grocery bill is closer than you think. Even as Brent crude eases toward $95 today, the structural damage to your purchasing power is already hard-coded into the system. Since the conflict began on February 28th, gasoline prices have surged over 50% in key markets, and diesel, the fuel that moves every product you buy, has jumped nearly 80%. Here's what the data actually shows. With 25% of American household net worth now tied to corporate equities, the record highs we're seeing in the S&P 500, hitting 7,022 just yesterday, are incredibly fragile. This is the wealth effect on a knife edge. If these ceasefire talks collapse, history suggests that for every 10% the market drops, consumer spending will contract by 1%. What this means for you is a double-sided squeeze, paying record prices for fuel while watching your retirement account become the primary collateral for global stability. I know many of you are watching these numbers and wondering how to navigate this shift. If you find this pattern-based analysis more useful than the usual noise, subscribe to the channel. It's how we build a community that sees the move before it happens. Drop a comment below on what you're seeing at your local station. The boots-on-the-ground data matters just as much as the charts. Most people stop the analysis at the gas pump. That is the mistake. The next 90 days will be the most dangerous period for the American consumer since 2008. While the market celebrates a record S&P 500 at 7,022, the underlying data shows the wealth effect is about to collide with the reality of $95 oil and a tightening naval blockade. Short-term scenario 30 to 60 day. The 2-week ceasefire brokered on April 7 is a fragile bridge. History shows that a pause without a full reopening of the Strait of Hormuz is merely a rearming period. There is a 65% probability of a volatility spike in early May as the naval blockade of Iranian ports intensifies. If ceasefire negotiations collapse, expect Brent to retest the $130 level within 14 days, triggering a forced liquidation in equities as companies move to protect transport margins. Midterm scenario 3 to 6 months. By late summer, the decoupling between Wall Street and Main Street will become unsustainable. We are tracking a 40% probability of a formal 15% correction in the S&P 500 as demand destruction finally hits the tech sector. This is the wealth effect reversal, where your paper gains evaporate just as energy-driven inflation hits a 12-month peak. De-escalation path, 15% probability. A full diplomatic breakthrough involving the unrestricted opening of the strait could see oil stabilize at $75 by Q3. However, with the current U.S. Treasury stance on Iranian sanctions, this is the least likely outcome. Here's what you need to understand. The pattern is clear. The market is currently priced for perfection in a world that is fundamentally broken. If you found this analysis helpful, share this video with one person who still thinks their retirement account is safe in this environment. The ceasefire is a countdown, and the real story begins the moment it ends.